Good evening, everyone, and welcome to our first Glassdoor webinar of the year. My name is Nieves. I'm Director of Investor Relations here at Astor Realty Capital, and I want to thank you for joining us tonight. This is one of our favorite webinars to do, not just because we get to share what we've accomplished, but because it gives us a chance to speak directly to you, our valued investor community. Whether you've been with us for years or you're just getting to know Astor, we're grateful for your participation. 2025 was an incredibly productive year. Together, we deployed over 38.3 million into new investments, spanning 929 units and more than 735,000 square feet of development. We also returned over 25.4 million in distributions back to our investors. And all of this builds on a foundation that now totals over $3 billion in real estate assets, over 4,000 units, and 4.6 million square feet. Our mission has always been to deliver consistent risk-adjusted returns through transparency, thoughtful structuring, and alignment. And tonight's session is part of that commitment. To help us walk through the year and look ahead into 2026, I'm thrilled to introduce someone who needs no introduction for many of you. It's Joe Berko. Joe is our founder and CEO, and he is a highly esteemed entrepreneur with over 30 years experience in the real estate industry. Under his leadership, as I mentioned before, Astor has grown into a nationally recognized private equity real estate platform. We deploy capital across major US markets through a blend of equity and debt strategies. Joe continues to guide our firm, your investments, and he takes us forward towards long-term success. So on that note, Joe, I'm going to hand it over to you.
Happy 2026. Astor just celebrated 10 years in operations, and I think we're sort of like stepping into a whole new area right now, with market turning back into normalcy and stabilization, and ultimately in the near-term future, we're going to start seeing growth again. With that in mind, Laura, let's put up the presentation. Okay, so we'll give you a quick review of sort of like the activities that we've done in 2026, focusing primarily on new assets that we've accomplished, new investments that came about. Let me see, I just have a bit of an issue moving this page. Okay. And as always, we'll do like a quick review for Q1 of 2026 to date. We're looking at a 21.1% average return across all of our strategies. And that's including investments in equity, investments in preferred position, and investment into debt structures. As of now, we're in 13 major markets, top performing US markets, with 38 transactions under Astor's belt and 18 exits as of late December. $3 billion altogether in real estate portfolio, and close to 3,700 units that include multifamily, high-end condominiums, some hotel units, and logistical centers. Under our management, from inception, $259 million and over 4.6 million square feet of beautiful commercial investment real estate across those various of 7 states and 13 markets. A quick review of what it looks like. So we have activities in Phoenix, Arizona, in Dallas, Fort Worth, Tampa, various markets throughout South Florida, Columbus, Ohio, which we've exited this year, Flemington, New Jersey, Newark, New Jersey, Manhattan, Queens, Brooklyn, Westchester, and a transaction that we've done in Chicago that we've exited from. Into the portfolio highlights and recap, I'll ask you, Alex, to take over, please.
Yeah, absolutely. It's great seeing everyone again. I hope you all had a great start to the new year. The goal here is to review basically our activity from 2025, and I think this deal will be, in everyone's memory, fairly present. So this was the Gold Street investment. We have a ground-up construction Class A multifamily here with almost 120 units, just over 100,000 square feet, and a project cost of about $86 million. Astor has placed an investment of about $7 million of preferred equity into this project. And we're expecting a profit over the next 3 years of about $4.6 million. So that's about a gross return of 21.75%. So it's rounded here to 21.8. So 65% in total return. So that was closed in December. Now, I'd like to share some updates here on our Celeste Midtown and Reserve projects. For those that know us a little bit, also know that we, over the past year, have made tremendous progress for our South Florida projects in Homestead and Davie. So those two markets are south and north of central Miami. Both of them are, fairly similar in size, but a little bit different in strategy. So, Midtown, south of Miami, we're building 354 units, just under 300,000 square feet. And, that is more, I believe, the Class A affordable luxury that we're targeting here. We have invested just under $4.5 million into this project, and we're expecting returns of just under 90% over the course of 2.5 years. The reason why it's so short is because we entered at a later stage of the investment. It was already shovel ready, and the investment that we placed was phased over multiple tranches. So we have about 3 phases containing 2 buildings each, and you'll see the progress here in a little bit. But those phases allow us to fund over time and therefore shorten the timeline because the lease up then is also much quicker. You don't have to build all 354 units before the first tenants can move in. It can be done when the first 2 units, the first 2 buildings are up already. The second project in Davie, Florida, is north of Miami, and again, very similar, I guess, building size of 350 units, slightly more expensive because land over there is a little bit more expensive. But yeah, very similar returns, and we've made tremendous progress on the construction for both of them. We have also just only now started drawing on the construction loan, so that helps keep the costs down. This is the Celeste Midtown project. As you can see here, we have multiple, I guess if you can see my mouse here, we have multiple buildings, and they are being built in phases. The first 2 buildings are, as you can see, very far advanced. The windows are being installed, and basically the building is up, and we're expecting TCO this year. So that means also tenants will start moving in this year for this first phase. And then the other 2 phases include the next 4 buildings for this. The construction project on Davie has also been really good. We've poured the 4 first floors of this building. So, whereas the other one were 6 individual buildings, this is one larger compound with parking underneath. And the 4th floor and 5th floor have just been completed. That is the amenity floor, which takes a little bit longer typically. But you can see here the location of this project is really good. You can see the Guitar Building, the Hard Rock Hotel in the distant future over there, and or not too distant distance over there. Moving on to our Brooklyn projects on Avenue U. These are projects literally touching each other. You can see here Onyx, and in the back here you can see Opal. And those projects are, very high-end luxury ground-up condominium projects. We have about 12 units in each of these buildings, whereas Onyx, we had just sold 2 units that were combined into one. So technically it's just 11 units. But we're expecting really good returns for this project. We've sold about 9 units across both projects here and have about $46 million in pre-sales. For the Opal, we actually had a TCO in the summer, and we had the first units move in. The staff started working there too, and we've gotten great feedback from the people that moved in. So, we're very happy with the progress that we've made there. You can see here that, the finishes are very high quality, and the same goes for the Onyx here as well. We have about a 6-month delay between both projects. That is due to different times of closing. Now I'll give it to Andrew to talk about the successful exits that we had and the distributions we've made in 2025.
Thank you, Alex, and good evening, everyone. Thank you for joining. As Alex said here, we have a couple of projects that have exited, some have partially exited, and many have made distributions. So the cold storage deal in Columbus, Ohio, that was a very successful exit, turning a existing cold storage facility, doing renovations to it, and selling it to an institutional buyer. We're very happy with that exit. The Conover in Brooklyn, that was a ground-up condo project. That one had a very difficult path, right? We entered that right before COVID started, and we're very happy to see ultimately the good results of that project. So very happy there. That's about $12.8 million in distributions that we made on those two projects. The Arc at Westchester Place in New Rochelle, that is a 144-unit Class A mixed-use rental. There we saw a partial exit thus far. The borrowers were able, or developers were able to stabilize the asset and bring in permanent financing. We were able to negotiate with the sponsors to take a $4.5 million distribution at that exit. And then there are brownfield tax credits, which I won't get into the details there, but basically they're going to be due in 2026, and we will see the remainder of our profit. So $4.5 million thus far on the $3.2 million that was invested, and we're expecting about another $1.2 to $1.5 million in the exit there. Bergen, Brooklyn project many of you are familiar with from these sessions. That is a condo project that started that got its TCO, has sold almost 80% of the units thus far, and has now distributed $3.4 million to date of the $5 million investment. And we expect to actually see another very large distribution in the next 2 months. They're taking an inventory loan, which you'll see in the upcoming report, which will allow us to return the remainder of principal as well as a good piece of the initial profit. Fulton, Atlantic, and North 7th Street, those are preferred equity deals that have a current pay component. About $4 million that's been distributed thus far on those deals. So all in all, in 2025, about $25.5 million of distributions that we made. We are expecting, at least in my, I like to think conservative estimate, at least 9 other projects in 2026, and likely in excess of $60 million that we'll be distributing there, as well as some additional preferred equity deals that are going to be doing distribution. So probably closer to 11 or 12 projects in all that will have distributions in 2026. And I'm thinking in the $60 to $70 million range. So as great as 2025 was, as exciting as all that was, we're fully expecting to at least double this number in January of 2027 when we're speaking with you all. So very very exciting times, and I know we're all proud of the work that we've been able to do thus far. So Joe, I will turn it back to you.
Thank you, Andrew. So let's take a look at the outlook for 2026. I call it a comeback here. If you look at the various fundamentals of the market and kind of like focusing on some of the sort of like the summaries of how things are looking. The federal chairman is about to be changed. We know he was very tough on keeping interest rate elevated and sort of like not giving the kind of relief that the market was really hoping in 2024. We started seeing some interest rate coming down in 2026, and that's by all respects considered to be a very positive thing. Change of sort of like the head chief over there, and that will certainly help because interest rate is obviously directly correlated to valuation and to how the market functions. As far as CoStar is concerned, FHFA is claiming that in 2026 in multifamily caps, we'll see a lot more capital going into the markets, about a 20% increase from the previous year, $88 billion from the previous years of $73 billion. So again, more liquidity into the market, lower interest rates. These are the signals that we're looking for in a comeback here. Regional banks are now coming back, and there's a larger increased volume in activity and increased volume in lending, not only in the ease of lending, but also expanding the amounts from or the loan to values or loan to cost, if you will, and allowing more developers and more purchasing to happen. In Politico, Trump is talking about $200 billion in bond purchase, again, showing more liquidity, getting more liquidity into the market and creating more of that lubrications that we're looking for in terms of capital available to work. According to CBRE, debt markets will remain healthy in 2026. And everyone was fearing the 2025 wall of maturities. There's been billions and billions of dollars of maturities that were coming up in 2025. There was a big concern about how those maturities are going to be refinanced over by the banks. But as we're seeing now, more lenders, more activities, and less defaults in all sectors, maybe not in the sectors of office, but everyone who knows this company for the last 10 years and probably from before that, you know that we are not big proponents of office, so we're not participating in that mess, that beautiful mess that has caused since the pandemic when in regards to office space. But again, that is now being easier to refinance and to kind of like roll it out and to lock it in for the next 5, 7, 10 years. And then overall, commercial real estate transactions are obviously looking to increase. There's an estimate of about 16% increase for $562 billion in overall transactions that are anticipated to happen in 2026. So again, more activities in line with what we're expecting. If we're looking at interest rate going back to 2019, right before the pandemic, we saw interest rates hovering somewhere for the SOFR index a little bit over 2% and then dropping into zero during the pandemic years and sort of like, hovering into 2020. And then we're seeing a very, very sharp increase in interest rate, a jump of over 500 basis points. That was the shocker for the market. 2022 was a very, very tough year. Into 2023. There was a lot of pain in the market, a lot of valuation, a lot of concerns. The long sort of like line between 2023 into deep into 2025 is sort of like the concern that everybody had and looked at the Feds and were asking start reducing rates and bringing the market some relief and some cheaper capital. But we're finally seeing it, as you can see right now in 2025. For the majority of the year, after some drops, we've seen a very flat line, and then we're starting to see declines again. There's an anticipation that interest rate will continue to decline. Again, the correlation between the two, between our markets and interest rates, is obviously extremely important. And we're starting to finally see that, the agencies are now putting capital out at 5%, 5.25%, and some are even saying that they can buy the rates down to below 5%, which is where exactly the market sort of like comes back. Now, those things don't happen overnight. Real estate always have some lag time, and so you will take a little bit of time, and we're looking into this kind of like slow ascent right now into a healthier market with a lot more transactions. What does it mean for Astor? How do we read the map, and what does it mean for our activities? In 2024, we came back to the market after a 2-year quiet period, understanding that the market has taken a hit and we needed to kind of like wait for things to stabilize at a certain, find a bottom, if you will. The first transaction we've entered, you, the investors, were making preferred returns at a 21.4% net to you, which was pretty fantastic. And we knew that we have a window. We knew that we have a window of a year, 2 years, short window before interest rate will start declining again, and then with it, the ability for us to continue paying such high returns will decline with it. In 2025, we were able to capture a few transactions that on the preferred equity side paid you between 16 to 18% with reductions of interest rate that will continue declining. Going back to several years ago, in 2018 and 2017, it wasn't uncommon that on preferred returns, 11%, 12% used to be the way of the land. That was the norm. For us to capture sort of like what we call the last tail of this cycle, our objective is to put together a fund that focuses on income. From what we've seen, the biggest demand from you, the investors, have been to go into deals that distribute quarterly and provide you 14, 15, 16, 18% returns. And in order for that to happen, we want to raise a certain amount of capital, team up with some institutional capital that is interesting with working with us, and capture several transactions throughout 2026, lock them in, and have this sort of like interest rate riding into the near-term future, into 2027 and 2028. In order to do that, we started one Astor Income Fund. And the last several weeks, we've raised somewhere between 15% of the overall fund that we were looking to deploy. We have a number of institutions that are circling around the fund, interested in the activity, familiar with the work, and want to join us on this and make this a successful venture. And so this is something that we believe will be able to sort of like lock in certain transaction. 2026 is an important year. What's the focus altogether is to sort of like do deals in 2026, lock them in, and then as deal comes back, simply return them back with the capital. So it's called a closed-ended fund. It's really no different than any other type of work that we've done. Only thing is this fund will not have any equity deals. Those will be standalone deals. And every investor will have the ability to participate into the fund or participate on a sidecar, which we can still participate on a deal-by-deal basis. It seems to me that the sophisticated investors have jumped in and taken chunks of the fund very early on, and also understand when they see a transaction that they like, they can also double down and continue investing alongside us. In terms of market selections, we circled around certain markets that we feel that are showing the type of dynamics that we're interested in, and that will be Texas, South Florida, Tennessee, New York, and some parts of New Jersey. Other locations that we're reviewing deals, kind of like more of a look-see, not necessarily jump right in, are Pennsylvania, Virginia, South Carolina, Georgia, and Colorado. These are good markets, and we're sort of like looking at them to see if there's a good opportunities, exceptional opportunities we'll explore, but the highest interest we'll have around those markets. Arizona, in terms of multifamily, is still suffering from oversupply, so we're looking into some rescue capital over there. And different markets have different strategies, right? Tennessee is kind of like experiencing very similar fundamentals like Arizona at this point. So we're looking at things very differently. Not everything will be multifamily. Some of the deals are going to be cold storage, similar to the deals that we've done in Columbus, Ohio. Cold storage, I'd like to say, is an anomaly. If you consider the entire universe of storage in all its formats, cold storage represents about 1.5% of the entire square footage of all of cold storage throughout the United States. Very tough deal to find, very, very coveted deals. We're actually negotiating a deal right now, and hopefully in the next couple of weeks, we'll be able to present that to you, but it's still up for debate. In the fund, in one Astor fund, like we've done in previous deals, in order to eliminate the need to negotiate and in order to eliminate the need to sort of like give special treatments to everyone, we decided to color it in 3 different areas. Give core, which is individuals that have with us all together with Astor $250 million, but under $1 million. Okay, so whether it is into the fund or whether it is all together throughout all of our transactions, and that gets a special treatment and will generate a 14.5% with quarterly distributions. The select, which is on to the right side, is folks that have been with us and have invested between $1 million to $5 million go into that category of 15.2. And then the premier category, which is what we're all hoping to see more and more of our investors heading into, is basically the top category where we take the lower amount of promotes. You have a lot more dollars with us, and we've been working together for quite some time. So we kind of like think about it between core being the disciplined side of the business, where we're disciplined and we're putting capital in and capital is working. The select, which is being consistent and keep on investing and keep on working with the company, and then ultimately reaching the goal of premier, which I'm happy to say that over the course of 2025, we're starting to see a lot more individuals and family offices and high net worth and some institutions moving into the premier category. And so we're thinking long term. We know it's a challenge. We understand it's a challenge, but we're giving all those abilities to sort of like participate in certain deals on sidecars, as we call them. So you don't have to participate in the fund, but we always advise individuals, put your capital into the fund, create diversification, and enjoy the ability to make better cumulative returns. Andrew, I'll bring it back to you to talk about the first transaction on 33 Magazine Street.
Yeah, so this is a construction loan that we have signed up. It is a $23.25 million loan for a 108-unit apartment building rental in the Ironbound section of Newark, New Jersey. This is a borrower that has built two very similar assets next door to this. So this will be his third asset in, essentially on the same block. Joe and I met with him. We toured the assets. Really, really well built. You can tell that he builds them to last. He builds them to hold them long term, which makes us excited there. We are bringing via the fund and a separate sidecar for this particular deal, $7 million behind a local bank partner. We're in the very, very final stages of due diligence for this loan. We finalized the budget. We're just waiting on our bank partner's approval here. And then we'll be moving forward with the legal documents and working towards the closing. Very, very excited about this one. Very good loan on a per unit basis. 60% LTV based on the appraisal that we got back. We've done a plan and cost review, which verifies the budget, verifies the timeline. We've done the environmental. Everything is good there. So again, very happy. And we've also, as is kind of the Astor way, we have a little bit of a cherry on top. There's $14 million of equity that the borrower has in the other two assets that are nearby. And we have that as an additional credit enhancement. We have that as a springing pledge of the equity in those buildings in the event of default. So, we think we have a really good deal here. We're very excited for it, and we're looking forward to closing this probably first or second week of February, if I have to guess, just based on the way that the loan documentation, all that kind of stuff will go. So for those that are interested in this one, we've gotten some very good excitement. We're looking forward to closing that and making this the first investment in the One Astor Income Fund. Joe, I know we have a couple pages here. There was one question I wanted to answer live from Robert. Just a quick update on the Miami Legacy project. Not a huge update, but still, we are still making progress. The developer has lined up a potential equity partner. This is somebody that would provide the balance sheet that is necessary to close the two loans that are proposed. One is a C-PACE loan, which is kind of like an environmental energy friendly loan. That is from an affiliate of Apollo. And then there is a mezzanine loan that is also proposed. So that balance sheet partner is in the process of going through the lender's due diligence. If everything checks out there, they'll be able to move the deal forward, and hopefully we would be looking at a closing in the coming months, which would take out the preferred equity that we have and make the project move forward. So, again, it's kind of like we're still a little bit of a wait and see, but it's a very positive update to start the year that our developer partner has been able to look into. So we should have another update probably within the next 2 or 3 weeks based on how that diligence is going and where we'll be able to see that project go.
As we come to the tail end of our overall presentation, I'm happy we got a chance to share with you some of the activity that we've had, deals that we've signed up and closed in 2025, deals that have exited in 2025, over $24 million, $25 million that was distributed. 2026 will be a big year, a lot of deals coming back, a lot of capital's coming back, and we certainly hope to redeploy it for you, our investors. Many of you have been with us over the course of many years. You've seen the commitment, you've seen the tough times, you've seen the great returns, and I think if there's ever a time to redeploy capital and to work with an emerging market, a market that's coming back, not emerging market rather, but a market that's coming back after a long hiatus, a long period of time of maybe quiet activity, this is the time. I like to give this analogy of a clock. Think about a clock, right? With 12 o'clock, 6 o'clock, we're sort of like somewhere at the 6 o'clock turning towards 7. So this will be the point in time where things are starting to move further up. And that is probably the best time to invest. Somewhere between the 4 o'clock and the 7 o'clock is the best time to invest because we're going to be able to see the swing. And so when we build something, we're going to see the upside when the market recovers and there's a lot more activity and banks are out there. When we are putting a loan out, it's going to be much easier for the loan takers to refinance or to sell the asset. All those things are going to translate into better returns on the equity side. Unfortunately, on the income side of things, we have to be very, very vigilant to catch as many as we can. Good deals, not compromising on deals, good deals, solid deals, so we can continue doing this type of distributions that we were able to do for you since 2024 in the last couple of years, right? We caught a very tough market. It was huge demand for capital. Capital was not available. What did we do? Contrarian, we went in and we all got the benefits. 21%, 18% type of returns that are coming back. Other places that we've seen opportunities, I was working with some of the greatest developers in various markets, stepping into projects where not a lot of people were building. Most builders were sitting on the sidelines, couldn't get access to capital. Capital was too expensive. The really great one was able to put shovels in the ground and actually work through it. And the result is, we anticipate that some of those deals are going to hit a market with very little supply because nothing has been built. This is actually changing right now. There's a lot of new construction starts that are happening. And so, in 3-4 years, we're going to see a new cycle. Usually the last part of that clock analogy, right? Call it between 9 and 12 o'clock is a period of time to be a seller. This is time that we exit from properties. It's time that we want to go very, very carefully into new projects because certainly there will be a 12 o'clock, which means the top peak of the market. And after that, unfortunately, there will be another cycle of some kind of a downturn. We don't know what it is, of course, but that's historically how things have been operating. So shy of any major event, shy of any geopolitical situation, and there's always something going on, especially with this administration. There's always, every week, there's a new conversation. Right now, it's Greenland. There's always something happening. So shy of some major geopolitical situation, I think we'll do extremely well with a market that's on a comeback. It's about 6:35. I want to thank you all for participating. We wanted to keep those conversations short. I know you got many other things to do. I want to thank the team for the hard work, for all the laborers. Sebastian, you can with your camera now, and as well as Laura. Sebastian, for those who are not familiar, joined us in 2023 and has been instrumental with all the things that we do in the background, and the reach outs and research and all that good stuff. Alex has been with us for a good number of years, started, I think, many years ago as an intern when he was a foreign student coming from Germany. He's been with us now for many years. Andrew and I go back for, I think now maybe a dozen years back, as well as Laura, which joined us when she was just a tiny baby, 20 years old, 20 and a half years old. As time flies. These are the great people of Astor, and we're here to have your money work as hard as it possibly can, right? Well, we're keeping our eye on the ball. We're not perfect. We don't claim to be perfect, but we work extremely hard to make sure that everyone is successful. There's other individuals, of course, part of Astor, on the origination side, on the capital raise side, that are not part of this, but these are your superstars right here. So I want to thank you all and wish you a fantastic 2026. And we'd like to see more of your participation in the fund. We'd like to see a lot of that movement moving forward. Thank you again, and God bless.
Thank you all, everyone. Have a wonderful evening.
For you.
You will have a secure future if you were to use Astor.
Hi, my name is Raquel El Khadif, and I'm a realtor with Broker Nation Real Estate in South Florida.
Hi, my name is Elena. I'm originally from New York, now currently living in Miami.
First and foremost, I was looking for my investors for institutional level investment. And the beauty of Astor is that an investor can come in with relatively a small amount of money and still be part of a big project with high returns.
Over the years, I've had many experiences with investing. I've learned so much, and approximately 5 years ago, I ran into a company, Astor, and found that they completed my investment approach. They are so selective with their projects.
The returns that they project are always high, but the track record is even higher than that. So it's kind of an element of under-promising and over-delivering, which I liked, of course.
Just based on years of trial and error and other companies that I've invested with, that they are far superior to all the other options that I've tried.
And it gives me and the investors some peace of mind.
I like that with Astor, I can sit back and have my money working for me.
They attract seasoned developers.
I feel very safe and secure with my investments with them.
I fell in love with them.
And I only use them now for my investments.
You guys made us feel like we're part of the family, and I thank you for that.